Welcome to the Daily Brief, where I'll go over the action in the market for Thursday, March 9th, and then we'll see how things look for Friday, March 10th. We had a pretty significant down day again. It looked like we were going to go higher right after the open, and prices did advance, but then some news kind of wavered into the market and sent everything lower, producing some fears and concerns, and when that happens, people end up selling more than buying. And it did a lot of technical damage to the market, but on a short and even intermediate term basis, we're looking a little extended to the downside or oversold. That doesn't mean we'll stop. It just means that we might slow down or maybe chop sideways, but things have really switched over to strongly negative at the current time. So let's go back and talk about what happened. Right at the open, we did have a gap higher open. Things were looking pretty good right out of the gate. But prices then hit resistance at R2 up at 4,018, and the R levels and S levels were pretty close to each other in Thursday's session because Wednesday saw a really tight range. And the pivot points that are calculated for Thursday are based on what happened on Wednesday. Then as the day went on, we hit that resistance level and we started going down. We fell down to the unchanged level. We also fell down to the daily pivot at 39.87, down to S1 at 39.74, then S2 at 39.57. We broke through the 200-day simple moving average at 39.40. We went all the way down to S3 at 39.26, and then we closed at S3. So things really shifted. We were down 1.85%, and this is interesting, on above average volume. We're lucky to get maybe one day a week now that's above average. Well, this was the volume for Thursday's session. We'll have to see if it carries over into Friday's session. The technicals, as I said, have really switched a lot more negative, and I have lots of charts to show you and some that I haven't shown in a while because of this inflation and interest rate scenario, which are producing growth concerns, and that's what hit the market on Thursday, especially in the banking sector, and that's then feeding over into the earnings per share as well as valuation concerns. Here's the intraday chart showing how we did gap higher. We gapped up at R1, came all the way up to R2. Things were looking pretty good, fell back, not necessarily a surprise, came down to the unchanged level, danced along there, which is a built-in support level. Well, when we weren't able to bounce back above that, we just broke to the downside, down through S1, S2. Here's the 200-day simple moving average in red, all the way below S3, only to close right at S3. What are some comments that we can make? The S&P lost its 200-day simple moving average at 39.40, and bank stocks led the market lower because of this concern about interest rates, higher deposit costs, as well as weaker loan demand. And all of those things tend to feed into profits that banks make, and so that's producing a lot of concern. We had some crypto news. Silvergate Bank is being liquidated. They're just going to shut it on down. And also SVB Financial, they're seeking to raise as much capital as they can because they're seeing a real run on their assets right now and people are pulling their money out. They have to raise that money somehow, so they're just selling off what they can to raise capital, similar to It's a Wonderful Life, where they ended with money in the movie. They don't know what's going to happen in this situation. On a short-term basis, our stochastic, Stoch RSI, and Williams percent are oversold. On an intermediate-term basis, we have our moving average study, the McClellan oscillator, the PMO study, the CCI 14, as well as the 20. The dollar was down and interest rates were down. This should have given some support to stocks, but it didn't. The market just wanted to go down anyway. All of our yield curves remain inverted. Sentiment has now drifted over to negative at 35, where we had been neutral at 45. Our trend is negative. The red line's still on top, but it's weakening. We're continuing to go down with the ADX, and we're below 20. Our bias is negative, and our momentum is negative. And bias is just usually one day. If we have an up or a down day, that's the bias, where momentum might be the last 2, 3, 4, 5 days kind of taken together. The economic reports that came out, we only had weekly jobless claims. They came in higher than expected at 211,000. They expected it to be at 198,000. Looking at the interest rate situation, this is how it was a week ago on March 3rd, where there was a 71.6% chance that they were going to raise rates 25 basis points. Then Chair Powell came out and gave his testimony before Congress, and it immediately switched to 72% saying, no, we're going to have a 50 basis point hike. And just to update this after Thursday, we're at 64.6%, saying there's still going to be a 50 basis point hike. The Ulster Index is continuing to be right down and about at the moving average, so it really didn't jump up with the down day. It had been going up, but then it really fell back down to the moving average, and it's staying at that level. The VIX on the down day did spike up, both on a closing basis with the line chart going up and with the bar chart. And the VIX of the VIX is also showing an increase in volatility. The VIX has been low for so long now, and it's when the VIX is low, it's time to go. And it's been producing a lot of complacency. Well, when we really start screaming to the downside, that really sees a pickup in volatility. Here's the condition of our trend, with the black line being the ADX. It's trying to turn back up, but it's still below the moving average. The red line's on top, the green line's on bottom. And even though we're not trending, we default to the negative. But we want to see this turn back up and go above the moving average for a trend to start to develop, and then have that confirmed by going back above 20, and we're far away from doing that. The daily chart showing how we're coming right down to this trend line that had been broken through. Now we're coming back down. Is this a test, or are we going to end up falling through to the downside? We do have some support down around the 38.77 level if we continue to fall. Down at the bottom, we can see where volume finally picked up and was above average. Here's the 2-year look at that same chart. You can get a little clearer look at this downward sloping trend line that we were able to break through. We're coming back down. It looked like we tested it once and started to bounce back up. Now we're coming right back down, and we could be breaking through that trend line. So we want to keep a real close eye on that. The Arun indicator showing that sellers are in control since the red line's on top and it's pegged that way, where the buyers are decreasing. So when you compare the two, our oscillators below zero and declining, and starting to get to kind of an extreme negative reading. So we could be oversold based on this. The weekly jobless claims came out. We saw a tick up in the weekly claims. That supports the idea that maybe employment is slowing down, but this is just one report, where in a whole slew of past reports, we've been seeing how jobless claims have been going down, down, down. The continuing claims also shot up a bit, but what I look at the most is the 4-week moving average. This looks inside the market, where the large cap growth did go down, but it performed better than large cap value. Value really got hit. It was down 2.13% for the large caps. It even exceeded the mid cap value, also was down more than mid cap growth, as well as small cap value did worse than small cap growth. Then in the middle, this is the ETF for the mid caps and the ETF for the small caps. You can see that the mid caps and small caps, which had been doing better up until just a few days ago, now they're seeing the most weakness. The latest reading that we received from the American Association of Individual Investors show that sentiment did bounce up a little bit. This was a week ago, so they reacted to that and were a little bit more positive. Next week, we'll probably see how this will come down with the down day that we saw on Thursday. If we have another down day on Friday, their sentiment could go extreme negative. Looking at the high beta stocks, these are stocks that outperform the market on the way up. Unfortunately, they outperform the market on the way down. They go down faster. When this ratio between high beta stocks and the S&P 500 equal weight index, where all stocks are treated the same, when this is going up, that means that folks are in a more risk-on scenario. They're getting into stocks and out of bonds. What we've been seeing over the last few days is this is really declining, and so they're getting out of stocks and getting into the risk-off type of investment, such as bonds, and that's why we saw bonds up. They were getting out of the stock market and going into the bond market now that interest rates are a little more attractive. Another measure that we look at, when this is going up, that means there's more fear. When this is going down, that means fear is subsiding. So we look at this the same way we do the VIX. This is a ratio between shorter-term bonds and investment-grade bonds, and this is starting to go back up. Just shows that fear is increasing. On a one-day basis, from Wednesday to Thursday, we probably overdid it again with our advanced decline ratio. We went down pretty far, pretty fast. The Stochk RSI, another short-term indicator, is now extreme negative, as is the Williams percent R. And the force index, it's not extreme, but it is really declining. Our short-term stochastic is extreme negative, followed by the intermediate term short trend. That is still negative, and we're turning back down with the long short term. The reason I use those terms is this is a further subdivision of the short-term time frame. So we have short-term, intermediate short-term, and long short-term. Looking at our moving average tree, we've broken down through all of the moving averages that we have on here, especially the 200-day moving averages. And this is interesting. I said we were watching this in yesterday's video to see if we get a change. Well, we did get a change. The parabolic SAR now has a dot on top. That is negative. So this has switched from positive over to negative. Chaikin oscillator below zero and declining. That's negative. Our PMO study shows that we're extreme negative with the PMOs that are rising. We're also back to extreme negative with the buy signals. And we continue to decline with the PMOs that are above zero. Swell trading oscillator based on price and volume continues to decline and is below zero. That's negative. The BPI broke further down below 50 as we were going lower in price. That is also negative. The NYSE bullish percent index, which is a broader measure of the BPI, continues to decline, but we're still above that 50 level. Chaikin money flow continues to decline overall, and this attempts to measure institutional money going in or out of the market. Moving average study, haven't seen this in a while. Extreme negative with the 20, declining with the 50, as well as the 200-day exponential moving averages. CCI 14, extreme negative, and CCI 20 is just barely negative. It's dropped a little below the minus 100 reading. Balance of power is negative and declining. TTM squeeze, a more red bar, so that is showing some continued weakness. The go, no-go keeps flashing all these no-go signs for the S&P 500, and it's a deep purple, so that is negative. Short-term fib levels, we do have some more possible support at the 39.08 level, and we're just above that at 39.18. We've broken through all the support on this longer-term fib chart, and we're still in no man's land with this real long fib chart, where the next level of support is around the 38.26 level. Our Ichimoku cloud is starting to show a breakdown. We've fallen below the green. Now this could recuperate. We have a big report coming out on Friday, and that could shift things more positive since the market is really anticipating what will happen with that report. But right now, it looks like things are turning more negative. The Elder Impulse system for the S&P 500 is now negative. And here's the McClellan oscillator showing we are extreme negative, but we could still go further down. And the broader range McClellan oscillator is negative and not necessarily extreme. Summation index based on price and volume are below zero and declining. New highs, new lows. Saw a bit of a breakout with the new lows, so our 5 period continues to decline and we're turning down with our 10 period. We've dropped below the moving average with the advanced decline line, so that is more negative based on price and volume. The advanced decline ratio below zero and declining with both the red line and the blue line. Accumulation distribution dropping below the moving average and turning down, so that's negative. This is one that's kind of interesting. We're getting close to a signal for the Kopik curve. We're not there yet, but if this black line crosses above the red line, that would be a buy signal. Now, other times when this has been a little more valid, we typically get a more extreme negative reading. But I saw this as I was going through the charts. I just wanted to bring this to your attention. Doesn't always mean that we're going to go jumping into the market, but this could be giving us a potential buy signal if we see a cross. Volume, which had been really declining, picked up in Thursday's session, so that's why the black line turned up. We'll see if that will continue. Then some of our chart variations. The Heiken Ashi, we have black candles. That's negative. The Kegi chart has switched to red and is declining. That's negative. The Renko has red boxes, that's negative, and the 3-line break has a black bar, and that has switched negative. Looking at the financials, I usually only show this in the intermarket analysis video, but we saw a real decline with the ratio between the financials and the S&P 500 all the way down to this 200-day moving average. Will it find some support and be able to bounce up off of that, or are we going to see things really start to decline, even though it's been in an overall uptrend? Looking at the Dow, it also broke below its 200-day moving average, and we have another support level at this S1 pivot point. The diamonds continue to be negative. The NASDAQ is down to its 200-day moving average. Will we find support at that level and be able to bounce up off of that, or are we going to break down below it? Where the NASDAQ 100 has not reached either the 50 or 200-day moving average, and we could be seeing a potential golden cross here, which is kind of contradictory to what's happening in the market, at least right now. The Qs are negative after being positive, and small caps really broke down below the 50-period moving average, below this S1 level. We still have the 200-day moving average below. Will that act as support if we go that low? And the Elder Impulse for the small caps continues to be negative. Looking at the small cap to S&P 500 ratio, we didn't really move all that much because both of these were down. We're in an overall uptrend, but lately we've been seeing a real weakness in the small caps compared to the S&P 500. Here are the mid caps where we broke down below the 50-period moving average, and we also closed below this S level. The mid caps, based on the Elder Impulse system, are negative. Looking at small caps, we dropped below this support level and we're continuing to fall below the 50 period, and we still have the 200-day below current price. Will that act as support if we continue to fall? Looking at the top, the RSI is starting to get extreme negative, and the MACD on the bottom is still declining. Looking at the home builders, this could be kind of interesting here. We're seeing this relationship get weaker and weaker. Usually when the S&P and home builders are going in the same direction, that is more positive for the market, especially when they're going up. Well, as the S&P has been going down, the home builders have been going down, the ratio has been holding up okay. So this potentially could be positive. In yesterday's video, I said it could be negative, but we're seeing the home builders start to outperform the S&P 500, and their relationship is not as strong and it's declining. So if the home builders are doing quite well, but the S&P is not, this could end up giving some support to the S&P 500. Looking at bond yields, they were actually down a bit on the day, where we finally dropped below this 4% level and have now stayed below that level currently. And here are bond prices, after really going down, have been starting to bounce back up. This is kind of interesting too. Another one of those strange situations where we're starting to see a golden cross with Bitcoin, but then Bitcoin's just been going down, 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 and the news is really bad. But this could be turning back over positive just based on moving averages. Now, there's lots of other indicators that you could plot onto this to get some other indications as to what's happening. But I just wanted to bring this up because we haven't seen a golden cross in Bitcoin since the latter part of 2021. Looking at our long-term trend, this is the S&P 500 weekly chart. We're starting to break down here. We haven't crossed below this MACD yet. Any more weakness, and that may continue to happen. What we're watching for is, this is the same trend line that I was showing on the daily charts, where it looks like we were breaking out. Now we're trying to determine, is this a fake out or is this breakout for real? We've been coming back down. We're right about down to this trend line again. At that time, the MACD was getting more positive and actually going above zero, which is not what happened in 2002 and 2008 into 2009. This looked like it might be showing a bit more strength because the MACD was looking a lot better. And I'll show this again in the weekly video update. But now that we're seeing some weakness and we're coming right back down to this trend line, the MACD is rolling over. And if we do drop below this level, we might see the MACD turn more negative, and that could potentially signal a fake out above that trend line. An update with our possible positive scenarios, nothing real positive about this. We're dropping below the zero line with our 10-day average of the highs minus the lows in the S&P. And the 2-year spike, which had gone up over 5%, has fallen back down, but we don't really know if that's a valid spike or not, which could give some support to the S&P if we start heading down with the 2-year yield. Our staples coming back up a little bit, but we're still working off of this really big spike right here, but that's just not giving a lot of support to the S&P. So what's our outlook for Friday? The employment situation report, that's the big one that's coming out. It's big all the time anyway, but it seems to have an extra dose of being really important this time. The technicals are negative, and in the short term and intermediate term, we're looking more oversold. Doesn't mean we'll stop. It just means we've gone down pretty far, pretty fast. We have the employment situation report coming out, as well as the Treasury budget. And then the whole list of geopolitical events, but it's inflation and interest rates that the markets are fixated on. All of our Fed speak, at least scheduled Fed speak, has been completed for the week. They may give some kind of an interview, either in the press or on TV, and that could whale the markets one way or the other. But these are scheduled speeches that have been completed. Then looking at the Stock Traders Almanac for Friday, March 10th, we're neutral to positive with the Dow being up a little more than half the time. The S&P is a little more positive, so it's neutral to positive, and the NASDAQ is more negative. It's only up 42.9% of the time, where for the month of March, we tend to be up 64.4% of the time. We're down historically 35.6% of the time. We still have this positive backdrop with the 3-0 trifecta with the Santa Claus rally, the first 5 trading days of 2023, and the January barometer. But we're just hitting a real difficult time right now before these things seem to come back into play. But the market also likes that we are split between Democrat and Republican within our government. Here is the historical look where we tend to have a down day. I'm following this green line here. This is the S&P 500 in a pre-election year, which is where we're at right now. We tend to have more of a down day. If we were going with a historical pattern and looking at this green line, we would have more of a down day, at least historically. In the backdrop is also this positive idea that March tends to be pretty strong, especially in a pre-election year after we had a bear market. And there's nothing magical about these statistics. You could be up 99 out of 100 times, but it's that one time when you're not, just blows all this out of the water. We just use this for some context and to get some background as to what has happened historically. And then based on this, we're also coming into that sweet spot for the S&P 500, but it's not very sweet right now. It's more sour. Our scenarios can't go with the down one because we're not trending and we are short-term and even intermediate-term oversold. Definitely can't go with the up one because we are negative. So we're still going with the sideways trend. Because the ADX is below 20, it's weakening, it's below its moving average, and it is negative. So if anything, we default to the negative side. Our conclusion, the S&P is negative, but short and intermediate term oversold. In the short term, we are negative, but oversold. Intermediate term, same thing, negative and oversold. Looking at the long term, we've now switched back to negative because we dropped below the 200-day simple moving average, even though we've had a recent golden cross. We'll have to see, is that going to be a fake out, or are we just going lower, testing some lower levels before we get set to go up higher? Thank you. I hope you found this helpful. I hope you have a great day on Friday. I will prepare the video for Monday's session after Friday's closed, as well as the weekly video, the intermarket analysis video, the deep dive video, and the supplemental video. So I will talk to you in the next video.